Okay, last question we have is assignment 17-19. Again, this is just one where we kind of pull together everything that we've been working on. So we have Dexter Limited beginning operations in 20X5, reporting the following income for the years 20X5 through 9. We need to prepare journal entries to record income taxes in each year, assuming that realization of the tax loss carried forward benefits is probable and the tax rate is 40% in all years. We then need to repeat requirement 1, assuming that the tax rate is now 40% in 20X5 and 6 and 43% in 20X7, 8 and 8, 47% in 20X9. Then we are going to return to the facts of requirement 1, where our tax rate is 40%, and we're going to repeat the journal entries for 20X8 and 9, assuming that use of the tax loss carried forward is deemed to be not probable in 20X8, but is probable in 20X9. So what we're going to do here is probably requirements 1 and 3 all together, and then we will look at requirement 2 after that. So once again, I've just pulled out all of the relevant information that we need. And so the first thing that I want to do is actually to calculate our taxable income for each of these years, because we do have temporary differences that we need to look at. Okay, so our pre-tax earnings in 20X5 were $8,000. We know that we add back any depreciation and we subtract any CCA, and that's going to give us our taxable income amount for that year. Now, of course, it's the same in 20X5 because we added back the $10,000 depreciation and we deducted $10,000 in CCA. But for the rest of the years, and I can make Excel do that work for me, you'll see that we do have a difference. Okay, so once I put this formula in, I can just drag it across. Excel will autofill for me using the same cells for the appropriate year. So my income tax payable for those years as it relates to my earnings times my tax rate is going to make Excel do the work for me. And I have all of that information ready to go for when I make my entries. Okay, so I'm going to start with 20X5. We had a positive taxable income in that year. So we're going to increase our income tax expense, and we're going to increase our income tax payable. And we saved ourselves some work and already did these calculations. We know based on a taxable income of $8,000 at a tax rate of 40%, our income tax payable is going to be $3,200. Okay, so fairly straightforward in 20X5. In 20X6, I think I want to do one more thing before we make the rest of these entries. 20X6 is going to be fairly straightforward again in terms of the amount of tax payable based on our earnings, but we can't forget that we also have an asset that we're dealing with, right? Because we have our depreciation, our CCA, our net book value, and our UCC. So this has the potential to create a deferred income tax asset or liability, and so we should look at that before we continue with our journal entries. So I'm going to put my years down the side here, 20X5, 6, 7, 8, and 9. We're going to look at our tax basis, our accounting basis, our temporary difference, our deferred tax, if we have an opening balance, and then, of course, any adjustment that we need to make for our journal entry. So in 20X5, we have a UCC of $90,000. And we have an accounting basis or net book value of $90,000 as well. excuse me. So I'm going to make Excel do the work. Oh, no, it's not going to work because I'm going the other way. Sorry. So I'm going to just fill in my tax basis for each of these years. I'm not deducting CCA. That was already done for us. The UCC is the amount that we are using as our tax basis in each of those years, and same for our net book value. Okay, we can see that the net book value was adjusted each year already for the amount of depreciation. So my tax basis minus my accounting basis is going to give me my difference. And now I can make Excel do some of this work for me. I'm going to multiply my difference times the tax rate in each of those years. I don't think it will take the right one if I do it that way. Now it's 40% for each of these years. So I don't have to worry about having different tax rates, but still we'll make sure we're taking the ones for the proper years. Okay. In year one, of course, I'm not going to have an opening balance. It would have been given to me if I did have one. But starting in year 3, I'll have my opening balance from the previous year. Okay. And then any adjustments that need to be made, we have here. Okay. So we can see in 20X5, we had no adjustment that needed to be made, and that's reflected in our journal entry. Okay, and we've used up this as well. In 20X6, however, we are going to have an adjustment that we need to record. So I'm still going to have income tax expense. I know that my adjustment is going to be a credit because it's showing in parentheses. So I'm going to have my credit to my deferred income tax. And then I'm going to have my income tax payable. Okay, so my adjustment is for $3,200. And we've now used up this. My income tax payable is going to be what I calculated for 20X6 based on my taxable income of $7,000. Adding those two together, I'll get my income tax expense of $6,000. $20X7, I'm still operating at a profit. Excuse me. I know that I have an adjustment, so my entry is going to look very similar to 20X6. My income tax expense, my deferred income tax adjustment for $1,600, my income tax payable for $2,000, and my income tax expense of $3,600. Now 20X8 is where things start to get a little bit interesting because now we've had a loss. Okay, so I'm going to start off with what I know. I know that I need to make an adjustment to my deferred income tax, a debit of $4,000, right, because this is not in parentheses. So we'll include that amount, and we will get that over and done with. Okay. Next, I'm going to look at what I've paid in previous years, okay, for my income tax payable. Those amounts are going to become what I am able to recover. So this question calls them something a little bit different. We actually are putting this in as our income tax receivable because we're actually going to get that money back. Okay? And that's based on what we actually paid in previous years. The next piece that I need to record is going to be my asset as a result of my loss carry forward. Okay? So we need to look at what that is going to be. I have a loss of $85,000. I recovered my 20x5, my 20x6, and my 20x7, which leaves me a loss carry forward of $65,000. That $65,000 multiplied by my tax rate of 40% is going to give me my deferred tax asset of $26,000. So my income tax expense or recovery in this case equal to all of these is going to be $38,000. In 20x9, again, we know that we have a deferred income tax amount, a credit for $4,000. Okay, so that came from our table. Now we don't have, sorry, we used up this as well. So we're back to earning a profit here. Okay, so I am going to have some income tax expense this time, but I am going to have my income tax payable. So we'll record those two things, and then we will look at the deferred tax asset in just a minute. Okay. So my income tax payable is going to be my $6,400 based off of what my earnings were. So my income tax expense is going to be the difference of $2,400. But I am going to be able to recover some of this, so I can reduce my income tax payable and my income tax expense as my recovery. Okay. And that's going to be for the full $6,400 that I would pay out as a result, because I know that I have more in my loss carry forward than my taxable income for that year, so I am going to be able to recover all of it. And my loss carry forward now at this point, $65,000 minus the 16 that was used means I have a carry forward of $49,000. Right? So, like I said, I want to kind of jump to requirement 3 for a minute and just look at what the difference is going to be in these entries if the carry forward is not probable in 20x8 but is probable in 20x9. So all of these entries are going to remain the same as requirement 1. Nothing is changing there. So what's going to look a little bit different is going to be for 20x3, or sorry, 20x8 and 20x9. Okay. In 20x8, I'm still going to have my deferred income tax for $4,000. I'm still going to have my income tax receivable for $8,000, and I'm going to have my income tax expense recovery. All I'm doing here is taking out the deferred income tax asset for the carry forward. Okay, if it's not probable, we don't record it in the book. So much of this entry is going to look the same. So let's save ourselves some work. Delete those out. adjust our income tax expense recovery, and there we are. But in 20X9, we do deem it to be probable. So the first part of our journal entry is going to look the same, right? Because we didn't do anything with our deferred tax at that point. That all stays the same. What is going to change is the second part of my entry. Okay, I'm now going to record my deferred income tax asset. And we need to look at what this is going to be recorded at. This is our loss carry forward. Okay. I just blanked for a minute on what I was doing. I did that to you guys the other day. I'm terrible at this. Okay, so our deferred income tax asset, we know that when we recorded it in 20X8, it would have been at 26,000. Okay, but since then, we want to recover the 6,400 from 20X9. So I'm going to take the amount of my asset and I'm going to subtract the 6,400, and that's going to give me my deferred income tax asset, and this is for my loss carry forward of 19,600. Okay, my income tax payable is going to be reduced just like it was in the previous entries, and then my income tax expense or recovery is for the full 26,000. Right? So now we can go back and look at requirement 2, and this is based off of the fact that we have a change in tax rate. So to start with, I'm actually going to borrow all of this, pull it down here, and just save a little bit of work for us when we are making these adjustments. Okay, so all of this data is based off of these tax rates, and we need to adjust it for these tax rates. So I'm going to get rid of my income tax payable because this calculation involves my tax rate, and I need to redo that part. So my income tax payable is going to be my taxable income multiplied by my tax rate for the appropriate year. Now, of course, the first 2 years look the same because the tax rates are the same between requirement 1 and requirement 2, but we do see the change in 20X7. I mean, we don't really need to do it for 20X8 because we had a loss, but just to keep things consistent. Okay, so that part is redone. When it comes to our asset, all of this is going to remain the same. It's not until our deferred tax column that we have a calculation involving our tax rate. So this is what we are going to change. And that's going to net out the rest of my table. So 8,000 times my tax rate for 20X6, 12,000 times my new tax rate for 20X7, 8, and 9. Okay, so we can see the differences that happen based on those different tax rates. I'm actually going to borrow all of this as well. Oh, I don't want to cut it out of there. I just want to copy it. And it's telling me that I have class with you guys. Okay, but we can see when we carried these forward that our amounts kind of got messed up. So we're going to pull all of those out. And we can start by making our journal entry. So 20x5 is going to look the same because our tax rate was the same as in requirement 1, right? We have a positive taxable earn or amount. So we increase our income tax expense and we increase our income tax payable. In 20x6, again, our journal entry looks very similar. I do have a deferred income tax credit, just like I did in the previous year, for $3,200 this time. I have my income tax payable and my income tax expense. 20x7, I still have a credit, so this is going to remain the same. $1,960 for my deferred income tax, which came from right here. My income tax payable, $2,150, making my income tax expense $4,110. 20x8, I now have a credit to my a debit to my deferred income tax for $4,260. Okay. Here's where things are going to start to look a little bit different when we look at our income tax receivable based on our recovery from the previous 3 years. Okay, so $8,150. Our deferred income tax asset, our loss carry forward is still $65,000, but we are going to multiply it by our new tax rate of 45%, which is going to give us $29,250. So my income tax recovery, $41,660. Okay. 20x9, we still have a deferred income tax debit, $4,660. So we want to include that. We're still going to have income tax payable, $7,520 based off of our 47% tax rate. Giving me income tax expense of $2,860. My income tax payable that I'm going to be able to recover because of that carry forward, the $7,520. Okay. And here's where things look a little bit different. So I'm going to have my deferred income tax asset. For my loss carry forward. And I'm going to have my income tax expense. Okay, so the reason for this is because, or that we have this in requirement 3 where we didn't in requirement 2, is that we have a change in our tax rate. Okay, so that means that we have to record that change, basically. So my income tax expense is going to be my $65,000, and I'm going to multiply by the change in my tax rate. So 47% minus 45% is going to give me an amount of $1,300. Okay. In the terms of my deferred income tax, I'm going to take the $65,000 and I'm going to subtract out the $16,000 that was used up in this year. That's going to leave me an amount of $49,000 that I'm going to multiply by my 47%, and it should give me, it's going to give me 20. Let me do this in a separate cell. 65 $1,245 minus 16 leaves me, or times my tax rate, gives me $23,030. Okay? But my opening balance was $29,250. So the adjustment that needs to be made to that account is going to be $6,220. Okay, the difference between those two based on the change in the tax rate. So that brought us to the end of 17-19. I will post this video for you. And that is it for chapter 17. You can go ahead and do the quiz.